Picture this. You're sitting at your computer watching numbers flash green and red on your screen. Your heart starts beating faster as you see prices shooting up like a rocket. Without thinking, you click buy and jump into the trade. Sound familiar? If you've lost money trading stocks, crypto, or Forex, you're definitely not alone. In fact, you're part of a huge group of people who struggle with the mental side of trading. Here's the real truth about trading. It's not about being a fortune teller who can predict where prices will go. It's about having the right mindset and following a simple, step-by-step plan. Today, we're going to learn 5 simple rules that will completely change how you think about trading and help you stay calm under pressure. Let me tell you a story that probably sounds just like your trading experience. You're staring at your computer screen, watching a stock price climb higher and higher. It's like watching a balloon filling up with air, getting bigger and bigger. Your brain starts screaming, "This is it! This is my chance to make quick money." So you jump in without really thinking about it. The price keeps going up, and you start feeling like a genius. But then, something terrible happens. The price starts falling like a rock thrown off a cliff. Instead of getting out, you tell yourself, "Don't worry, it's just a small dip. It'll bounce back up soon." But it keeps falling and falling and falling and falling. Now you're thinking, okay, maybe it'll just go back to where I started and I can get out without losing anything. This is like being on a sinking ship and hoping it'll magically float back to the surface. Your account gets destroyed because you let your emotions drive the car instead of your brain. If this story sounds exactly like what happened to you, welcome to the club of 95% of traders who lose money. But don't worry. There's a way out of this mess, and it starts with understanding what went wrong. Let me show you how this disaster unfolds in real life using a simple example. Imagine you're watching a chocolate bar stock. The price starts shooting up like a firework on the 4th of July. You see this massive green bar that breaks through all previous levels, and you think, "This is my golden ticket." You buy the stock, feeling super confident. Then, the next bar turns red. Because you don't have a solid plan and you panic too easily, the next 2 red bars scare you out of the trade. The stock starts moving sideways like a car stuck in traffic, and then suddenly another green bar appears. You think, "Oh my goodness, I knew it was going up. I'm getting back in." So you buy again, but you're still scared and bail out too quickly. The next 3 red bars kick you out again. This happens over and over, like a cruel game of musical chairs. Each time you think you figured it out, the market proves you wrong. Finally, you decide to hold on forever, and all the stock does is crash down like a house of cards. This is exactly like gambling at a casino. The house always wins because they know people will get emotional and make bad decisions. Market makers, the big players, make money off people just like you who trade with their hearts instead of their heads. This is why you absolutely need a rules-based trading strategy. But what does that actually mean in plain English? Think of it like following a recipe to bake a cake. You don't just throw random ingredients together and hope for the best. You follow specific steps in a specific order. When you start trading, you create a recipe for success. You test this recipe many times with fake money to make sure it works. Once you're confident it works, you use real money, but you never, ever change the recipe just because you feel like it. Let's say your trading recipe involves something called moving averages. Think of a moving average like the average temperature over the past few weeks. If the current temperature is below this average, you know it's been getting colder. If it's above, it's been getting warmer. Your rule might be, only sell stocks when the price is below the 21-day average temperature and only buy stocks when it's above. But you also need multiple signs before you make any move, just like a doctor needs multiple symptoms before diagnosing a patient. Here's how it works in the real world. Let's say Apple stock is below its 21-day average, and it's showing downward momentum like a ball rolling down a hill. That's 2 signs. Let's say you also look for special candle patterns that look like spinning tops, called doji candles. When you see a doji followed by a big red bar, that's your 3rd sign. Now you have 3 confirmations, like 3 doctors agreeing on a diagnosis, and you can make your trade. This is what having a rules-based trading strategy means. You need at least 3 green lights before you enter any trade. You never trade just because you see prices moving, just like you wouldn't drive through an intersection, just because you see cars moving. Here's what I want you to do right now. Get a notebook and write down your rules like you're writing a recipe. Don't make any trades until you have 3, 4, or 5 specific conditions checked off your list. When you see something exciting on the charts, don't click buy or sell immediately. Look at your list first. Make sure every single box is checked. This way, you're using your brain, not your emotions. This brings us to our first rule. Always follow your trading recipe. You have to trade based on your written plan and logical thinking, not gut feelings or emotions. Our second rule is just as important. Never trade when you're emotional. When you get emotional, you're like a drunk person trying to drive a car. This is exactly what the big players want. They set traps that look amazing, you fall for them, and you lose your money. This happens over and over again, and it's why 95% of traders fail. Let me give you a real-world example. Imagine you're at a casino, and you just lost $100 playing blackjack. You're angry and frustrated, so you decide to bet $200 on the next hand to win back your money. What do you think happens? You lose again, and now you're down $300. Trading with emotions is exactly like this. The third rule is about risk management, which is like wearing a seatbelt when you drive. If your trading recipe is set up so that you risk $1 to potentially make $4, then winning one trade means you can lose the next 4 trades and still break even. It's like having a safety net under a tightrope walker. Think about it this way. If you're a baseball player and you hit 1 home run out of every 5 at-bats, you're considered excellent. Trading works the same way. You don't need to win every trade. You just need to make more money when you win than you lose when you're wrong. Proper risk management is like having insurance on your car. It protects you from disasters and helps you sleep peacefully at night. When you have good risk management, trading becomes as systematic as following a cooking recipe. You follow specific steps before making any trade, just like programming a computer. Think of your trading brain like a robot. This robot will not execute a trade unless specific conditions are met. It's like a security system that needs 3 different keys to open a safe. Never click that buy or sell button without knowing exactly where you'll take profits and where you'll cut losses. This is absolutely non-negotiable. Our fourth rule addresses a mistake that's like trying to watch 10 different TV shows at the same time. Many traders, especially those who can sit in front of a computer all day, try to trade everything at once. You might have dozens of trades running simultaneously, which is like trying to juggle 50 balls at once. When you're looking at too many different things at the same time, you're bound to make mistakes. I've done this myself many times. I'd be analyzing one stock, then pick up my phone to place a trade, only to realize I just bought a completely different stock than the one I was studying. It's like studying for a math test and then accidentally taking a history exam. Don't spread yourself too thin. Focus on 2 or 3 stocks or currencies maximum. Don't use too many indicators or draw too many lines on your charts. Keep it simple, like learning to drive with just the basics: gas, brake, and steering. Trading really isn't rocket science. This brings us to our most important rule: never engage in revenge trading. Revenge trading is like getting in a fight with someone who's much bigger and stronger than you. It happens when you just lost a lot of money on a trade and you're boiling mad inside. You start looking for the next opportunity to get your money back because you feel like the market stole from you. Let me paint you a picture. Imagine you're at a carnival playing a ring toss game. You lose $20 and you're furious. So you decide to bet $40 on the next game to win back your money. You lose again. Now you're down $60 and you're even angrier. You bet $80 on the next game. Can you see where this is going? You end up losing hundreds of dollars because you let your emotions take control. When you get angry and start revenge trading, you throw your entire plan out the window. You start making trades like a person having a temper tantrum. But what happens when you trade with emotions? You lose over and over again because the markets are specifically designed to take advantage of emotional people. Instead of losing a couple $1,000s on one bad trade, you can end up losing 10, 15, or $20,000 in a single day because you're angry and trying to get revenge on the market. It's like trying to fight a tsunami with a water gun. If you're in a bad mood, if you just had a fight with your family, if you're stuck in traffic and feeling stressed, do not trade. If you're angry, turn off your computer, put away your phone, and go for a walk. Do not trade when you're emotional. It's like trying to perform surgery when you're drunk. It's the worst possible idea. When you practice these rules using fake money on a demo account, something magical happens. All the stress and emotion disappears from trading. I used to be such an emotional trader that I would break out in a sweat every time I made a trade, wondering if I was about to lose everything. Now, when I place a trade, I look at my checklist, enter the trade, set my safety levels, and then walk away. I'll go make a sandwich or watch a movie. I have no emotional connection to the trade because I know my system works. It's like putting a cake in the oven and setting a timer. You don't need to stand there and worry about it. I execute trades and stay calm throughout the entire process. I don't worry or stress about my trades anymore. This approach is incredibly peaceful compared to how I used to trade, sweating bullets and checking my phone every 5 minutes. The secret is to relax and keep everything simple. Have clear rules written down and follow them religiously, like following a GPS when driving to a new place. Practice different strategies to find what works for your personality. Some people like quick trades that last a few minutes, while others prefer to hold positions for several days. The key is finding an approach that fits you like a comfortable pair of shoes. Set up a practice account with fake money and start trading without any financial risk. This will calm your nerves immediately and help you build confidence in your system. After a month of consistent practice trading, you'll see whether your system actually works in the real world. Once you've proven your system works with fake money, you can start using real money. Stick to your systematic approach and slowly build profits over time, like growing a garden. Your trading account will grow steadily as you follow your proven methods and maintain proper mental discipline. Remember, successful trading is about developing the right mindset and following a simple, systematic approach. These 5 rules will transform your trading psychology and help you join the small group of traders who actually make money consistently. It's not about being the smartest person in the room. It's about being the most disciplined person in the room.